RealAg Live, everybody. I'm your host, Shaun Haney. Thanks a lot for tuning in today. Really, really do appreciate it. If you want to participate in today's discussion, all you have to do is enter your question or comment in the box, whether you're watching on YouTube, Twitter, or Facebook. We're going to geek out today on economics, and I'm sure inflation is going to come up several times. Something we're going to chat about today. Today's guest is JP Gervais from Farm Credit Canada. JP, how are you?
I am very well. How about yourself?
Hey, man, I'm doing fantastic. Really hoping for some audience questions today. So, like I said, they are very, very welcome. I got a bunch of questions for JP, but we would invite you to participate in today's discussion as well. JP, I've really noticed this week, and I know there's people talking about inflation prior to this week, but I'm really noticing in the mainstream financial news this week, all of a sudden, it's all about inflation concerns. How concerned are you about it?
Well, I would say that my concern level is not as high as you're right, as we are feeling it or sort of, perceiving it to be in the media, right? So the one thing about inflation, and it starts to be real when everybody believes it, so to speak. I remember, first year of graduate school, my textbook in macroeconomics was called, the macroeconomics of self-fulfilling prophecies. And if I can summarize, a number of pages in just a couple of sentences, the point being that inflation is a threat when it starts to be a threat when businesses and households start to have expectations about future inflations, right? So it's all about the fact that if I as a business, I'm seeing that my costs are going up, then I need to pass it on to downstream in the supply chain and so far. Now the thing that we all know in farming is that it is really hard to do. And that's why the markets are there, right? To arbitrage this relationship between the cost of materials, what consumers are able and willing to pay. The one thing that has changed now recently, on top of the fact that raw materials are moving up in prices, is the fact that income's super strong, right? Savings are up, debt to disposable income slightly down. It's not as much as lower as everybody would like, I suppose. But overall, there's quite a bit of a case to be made. There's a pent-up demand out there, and that's the concern behind the inflation pressures we're seeing right now.
Well, there's still a lot of people out of work as well in Canada and the U.S., right? So we can say that, hey, the economy is going to be humming in 2021. We're going to see this inflationary pressure, but we still got some people that are out of work.
Right. And expectations because of this, among other things, but because of this, expectations about future inflations are well anchored around that 2% range, right? A little bit above, a little bit below. And I believe that most businesses, anyhow, and consumers as well, would think that, yeah, we're comfortable with the fact that the bank seems credible in terms of holding inflation around that 2% target. And we understand that it can deviate from that a little bit. And as long as we're not seeing we don't see anything that would change our expectations. And one of the things that would change, for example, is if businesses report that they are more likely to raise prices. And so if they do so, it means that they are getting the signals that other levels of the supply in the supply chain are able to absorb some of these higher prices, right? Mm-hmm. And the next, I think, evidence. So we just got an inflation reading this week, right? So it was 1.1% in Canada in February. And the next big report in my head is the one that will be released in early April, which is the Business Outlook Survey. And what it does is the Bank of Canada surveys businesses about a number of things, whether they're faced with some capacity constraints and so forth. And they're going to ask, what is your intent when it comes to prices? Are you planning to increase your prices in the next 12 months? At the end of December, which was the last survey, there was a slight share of businesses, more businesses that thought that prices were going to raise or were going to increase, but it was fairly stable. But if that was to change in March, I think that would be the beginning of, me getting a little bit more worried about where future inflation is likely to be.
Okay, so you need to explain this to me then, because I printed off, because that's what I do is I print off a ton of articles I find on the web. This article was in the Wall Street Journal this week, and it talks about prices of lumber and other building materials and how that's leading to skyrocketing costs for home builders. It says lumber, one of the biggest costs in home building after land and labor, has never been more expensive and is more than twice the typical price for this time of the year. Crude oil, a starting point for paint, drain pipe, roof shingles, and flooring, has shot up more than 80% since October. Copper, which carries water and electricity through houses, costs about a third more than it did in the autumn. Hearing those numbers, JP, for just building materials for a house, how can we say that there's not inflationary pressure? Why isn't that translating to a bigger number?
Well, so the question is, yes, there's inflationary pressure, but is it transitory, right? Is this something that we expect it to be permanent of nature so that the bank would change and shift their outlook on monetary policy? And so that's the reason why I'm saying no. But you're absolutely right. And I believe it's in the same article that a builder was saying that, you know what, with rising prices, I did lose a few customers or I did lose a few sales. And so that's what's going on. Prices are going up to ration, what is available in the marketplace. And if it is successful, then I would think that those inflationary pressures are going to subside after a few months, maybe up to 12 months, who knows. But if it's a case where we got lots of money chasing too few resources, and the fact is that even if you start raising prices, then you're not seeing the rationing of the market, and then you're seeing demand as strong as it has been for a number of months because there's been quite a bit of stimulus and so forth. Then that's when you start sort of worrying about what could happen in the marketplace. But as you said, wages are not expected to go up. The labor market's still weak. Still some unknowns to how we're going to get out of this pandemic. So all in all, I do think that it's under control, but that's definitely on the horizon for sure.
Yeah, the National Association of Home Builders say prices have added $24,000 to the cost of building the average single-family home and about $9,000 to the apartment. The group was quoted as saying, current prices represent an intolerable and frequently insurmountable financial burden to home builders and contractors. They're breaking out all the words there. Okay, so we had the Federal Reserve had a meeting this week. Talk about the U.S. economy being very robust. 6.5% growth in 2021. That's putting a big number on the board, so to speak. What does this mean for the Canadian economy if they actually do achieve that?
Well, I think it's good news. First of all, the U.S. is really a unique situation among all Western economies, right? So if you put all the countries together and look at their growth forecast for 2021, the U.S. is clearly ahead of the pack when it comes to gaining back what was lost during 2020 because of the pandemic and adding on more. Whereas in Canada, I think we're going to be okay to gain back what we lost now in 2020 and perhaps show a little bit of a gain at the end of 2021 with respect to where we were prior to the end of 2019. But the U.S. is just way above where we're expected to be. Same with Europe and so forth. A lot of it depends on the stimulus in the U.S. and from what we know, I mean, the checks are going to have an impact on the actual consumer spending. The U.S. remains, by and large, a consumer economy. It seems that container shortage that we're experiencing worldwide, which does a lot for smooth trade flows and so forth, and the growth in the U.S. and China. So all of that seems to be trending in the right direction. So I'm not too surprised. What I'm surprised about is the Federal Reserve being so outspoken about the likelihood that they're only going to look at raising rates by 2023. That's also the message of the Bank of Canada. Yet, you're seeing bond yields go up. I find it fascinating that in the span of a month, if you look at where 10-year bond yields are currently, where they were about 5 weeks ago, we're a good 50 basis points higher than where we were 5 weeks ago, which is, again, going back to what we discussed at the top, that the markets are getting nervous about future inflation. Central banks are keeping it cool for now, saying, hey, everything's okay. We got it under control. We're going to withdraw the monetary stimulus, but the fiscal stimulus is out there. And in the U.S., quite big. And that is likely to have an impact on interest rates going forward.
So that's
timing of it is unknown.
That's the yield curve steepening then. Is that right?
Correct.
Yeah.
Yes. the yield curve is moving up for longer term yields, right? So it's the yield curve getting steeper, but at the far right of the curve. So meaning that the 5-year, 10-year bond yields are moving up, but everything else short term staying where it is. It hasn't moved because of the statement, the commitment of the banks, the central banks, both in terms of what they're saying with regards to their policy rate, as well as the monetary stimulus that they are putting in the economy.
Yeah, we saw. I think we had Brazil raise rates They were the first country to raise rates since COVID-19 this week. Um, so, do you think that, like, although they were transparent on this not till 2023, do you think they're going to be able to, like, when the economy is growing at 6.5%, that we talked about inflation a little bit already. This is going to be a continued question. Every single Bank of Canada and Federal Reserve meeting is the when. Like, just because they say 2023 today, it's not like, okay, well we'll ask that. We'll wait till January of 2023 and we'll ask you the question again. There's going to be a lot of pressure here to at some point to start raising rates if this thing gets really, really steamy. And when I say steam, the economy getting really roaring, if the roaring 20s do return, as some people are alluding to, right? Like this pressure is going to get more intense.
Yeah, that's exactly what it is. And for any business operation or any business right now, the challenge is not to assume that because there's a statement out there around 2023 that you're okay and you're fine not to think about interest rates for the next year, and to get you to, middle of 2022. And then I'll start, looking at what's going on in the marketplace. I do think that you have to be paying attention before that, for the reasons that I just mentioned. Rates at the end of the curve, the yield curve, longer term rates have started to move up. And that's because of the markets being anxious a little bit about what they're seeing in terms of inflation behavior. So it's one thing for the bank to credibly say, we're not expecting to raise interest rates. It's another thing for markets to fully buy in the Bank of Canada and the Federal Reserve arguments. I do think that there is concern from the financial markets. And right now, that's concerns that are under control. But as I said, for a business, I do think that it's quite critical to have a plan when it comes to financial risk and understand that at some point I'm going to have to look at what the markets are doing.
Yeah, and you got to remember, this has been a short-lived sort of thing. It goes back 12 months ago when COVID first hit the shores of North America, where we saw this aggressive decline in rates to try to save the economy from collapse. So you like at least getting back to those pre-COVID levels. It will be you imagine part of the discussion. So why, hearing all of this, why are we still, and I say we, I mean the Canadian and the U.S. government, we saw a $1.9 trillion COVID stimulus package. Now that's all not money for COVID relief. That money's being flowed in a whole bunch of different directions. But why are governments still talking about COVID stimulus when at the same time we're talking about a U.S. economy at 6.5%? How does that match up?
Well, I think there's a lot of politics in it in the U.S., and I'm not pretending to understand 100% of U.S. politics, but I lived there for 7 years, and I know a little bit about how everything works out. And reality is, when you look at what we call a K-type recovery, right? You and I, Shaun, have mentioned this, right? This is the letter K pointing upward. So there's a segment of businesses and consumers that are doing absolutely fine. Some that are doing super good in this environment. Whereas there's another segment of businesses and households that are not doing well. And I think this inequality is playing out in the US for sure. And I don't want to say right off the bat and dismiss the idea that no, there are some households that really need the stimulus checks that are going to be going their way, especially in the US. Given the inequality that existed prior to the recession in the US. That's been well documented. And so it is easier to pass a package, I would say, in the US that has this this one size fits all almost. I mean, I understand that there's some trade-offs at the top end of income where you're not going to get any stimulus, but just the closer you are to one size fits all makes it a lot easier to pass a package in the US versus any type of structured, targeted plan like we've had in Canada. Now, in Canada, it's been quite a bit of stimulus as well, but I would argue it's been more targeted to right or wrong, has been more targeted to a segment of the population and a segment of businesses.
One heck of a jobs number on the last jobs report. That was a big number put on the board. Phil has a question here related to the stimulus. Should governments be concerned about debt levels? Should it be paid back through HST or income tax, or are there other ideas being thrown about? I've heard a lot about a wealth tax. What are your thoughts, JP?
Yeah, wealth tax in the U.S. has been definitely discussed as well. I have heard mentions of it in Canada as well. I mean, so here's the thing with debt to GDP is really the one ratio that everybody's going to talk about, debt to GDP. So that's the one ratio you have to think about. Now, don't want to get into the details, don't want to get into the weeds, but there is net debt and there's gross debt. So if you look at net debt, which is basically accounting for some of the fact that, you have that debt on your books, but, you have some assets that can actually be liquidated that would lower your debt load, right? So for a country, there's quite a bit of evidence that puts that debt to GDP ratio at 70%. If you stay under 70%, that's not a target in and of itself, to say, oh, I can get there. But the evidence is pretty clear that starting around 70% is when you start to get to points where you're running into some issues, meaning that your debt load is having an impact on your competitiveness, future growth, blah, blah, blah. So in Canada right now, I haven't looked at the numbers, and top of my head, I can't recall the net debt to GDP number in the US, but in Canada, we will be by the end of this fiscal year at above 50%. I would suspect maybe up to 55. I don't know, but let's just, put it in a range of 50%. And so that, makes it less of a concern short term. Now, it's not to say that you can sustain that, forever. This is short term. This is, I do think manageable, quite manageable, especially where interest rates are. Actually, if you look at the data, the debt repayment capacity is actually projected to improve given low interest rates. But that's assuming, again, going back to our discussion, that interest rates remain low. So at one point, you're going to have to address this debt to GDP ratio. And it seems to me that it'll be hard to address without addressing the revenue side of the equation, right? You can look at your deficit and pay down that debt by looking at your expenses or your revenues and cutting back spending and so forth. I'm not so sure that this will actually do the trick. I think you're looking at, at some point in time, and I'm not suggesting it should be anytime soon, and I'm not suggesting that you should do it in the short term, but at some point in time, perhaps raising revenues. And so how do you do it? There are different levers that you can use in Canada and the US. And then it becomes a matter of policy and what you want to favor and support.
Well, you talk about net debt versus gross debt. It's the same thing when it comes to the wealth tax. We've talked a lot on RealAg Radio about this topic. If it's on gross assets, farmers are in trouble. If it's on net assets, farmers will probably, based on some of the thresholds I've seen thrown around, probably most farms, 99.9% of farms would never qualify for that tax. So that net versus gross, it's one word, but boy, that is a difference.
Yeah. I remember at the outset of the pandemic, I've seen the most misleading chart when it comes to debt to GDP, because it was looking at the growth in debt to GDP ratio. Now, if you start off from a number that is lower in Canada than it is in the US, and you add on to this debt to GDP, obviously your numbers are going to look bad. Whereas in the US, if you start off with a very large debt to GDP ratio and you start adding up to that large number in percent, what you're adding on to that ratio doesn't look as bad as, for example, what would be added in Canada. So you have to be careful here. This is okay in the short term, especially given the amount of financial strain and stress that there is. Now, of course, there's been a lot of stimulus. And like, as I said, I'm not debating the optimal policy and mix and so forth, but I'm just saying that there was a subset of households and businesses that needed some help and
Yeah.
support. And now after a while, we'll have to, once we get back to normal, reopen and so forth, and it seems that the uncertainty is lifted, probably going to have to be thinking about how to bring it back to the levels that we had in the past.
Okay, Phil's pressing you on this. So let's get JP, the economist. I mean, it's not necessarily the viewpoint of Farm Credit Canada. JP Gervais, economist JP Gervais. Is it better to use like a consumption tax or an income tax? Is there a preference from an economist standpoint?
So from an economist standpoint, so I'm going to answer first not to use a capital tax of some sort, because that's where you're deploying capital makes the economy grow. So you want to do that. Consumption tax is quite useful, and that's the reason where a lot of people in the US are not so nervous about the size of the deficit and the debt, right? Because the US has no GST equivalent. And so it'd be hard politically to do it in the US, but it would be easy also in a way to sort of raise revenues to get at spending if you don't want to tax capital and tax labor, so on to an income tax. So consumption is, I would say, the best, one of the tools that you have if you structure it so that you're most financially exposed, let's say, or at risk, are not hit more proportionally by a tax, because that's the one drawback with a tax is that you can't make it as progressive, for example, as you'll make it with the income tax structure that you have. So it's really a matter of balancing, but a consumption tax to me would raise the revenues in a way that would bring less distortion in the economy.
Yeah, well, and a lot of people in Alberta, wondering the is it maybe not even an if, it's when at some point does a province like Alberta have to put in some sort of a sales tax. Okay, so let's talk a little bit about. I want to hit on trade here before we wrap up. Based on what we're seeing from a global economic perspective, are you pretty bullish on Canadian agricultural exports here for 21?
I am. The big question mark is we're receiving some conflicting signals out of China, which I think we're going to require another month or two to sort of understand exactly what is the situation with African swine fever in China and the volume of grains and oilseeds versus meat that they're going to require. I do think that ultimately, when that uncertainty is lifted, that's going to create quite a bit more clarity around where we're going to stand when it comes to trade. Looks as if the container crisis is somewhat moving in the right direction or trending in the right direction in terms of availability of containers and so forth. So that's also another good sign. That's something that I would keep an eye on for sure when it comes to our ability to export. So yes, I am actually thinking that we're going to get a good year. If we get a good crop, again, no one knows, but there's just so much that we don't know yet. But I am actually optimistic with regards to 2021 exports.
I had it in my news readout for RealAg Radio today, but I don't have it in front of me. But Rabobank was talking about the biggest concern they have in terms of agricultural trade for this coming year is definitely ASF and what is the impact or what is actually going on in China, which I'm not sure anybody really knows. But that's what they identified as their big item to watch.
The evidence coming out of USDA is also super confusing, because their official forecast is quite negative, which seems now to match up what we're hearing in terms of reports coming out of China and the reemergence of the virus and so forth. Whereas the evidence of the numbers coming out of the USDA or FAS, USDA offices located in China are actually quite optimistic and support China's government story around the rebuilding of the herd and so forth. And so that's the part where probably the truth is somewhere in the middle as usual. But it's just getting that clarity around like what exactly demand is going to look like from China is going to matter a great deal. But at the end of the day, I think it matters more for the U.S. If we can get our full ability to export pork to China, I think that would be a real positive. And the demand for grains and oilseeds, well, I do think that is going to remain strong. So overall, our shipments are likely to be pretty strong in 2021, I would say.
I saw a report, I read it on the news a couple days ago on RealAg Radio, talking about how there was a survey done of fund managers in on Wall Street. And they said the biggest risk to the market, when they're talking about the market, they mean the equity market, let's assume that, the biggest risk to the equity market is inflation, more so than COVID-19 was taken off of the pedestal. I guess that's a good sign that vaccines are being rolled out and we're getting through the pandemic, or getting to the other side of it at least, or almost there. But they were bringing up inflation, so like you said, it's definitely it's in the news. And when does perception kind of become reality? It's a good way to kind of look at that topic.
Self-fulfilling prophecies. I get back to that. If you and I start believing it and we're successful passing on some of our costs and imagining that we're very, very successful, I know you are, Shaun, very, very successful business owners, then it starts to just snowball where everybody's building those expectations. And just the fact that you and I had expectations about what inflation could look like makes it real and makes it actually the outcome, which is really what it is about if there's one thing we learned about the last 20 years of monetary policy and inflation targeting, is that you have to be, credibility matters a great deal. And the credibility is all you have as a central bank, and you want to make sure to keep it. And so I do expect that at some points, if central banks need to acknowledge and recognize that, there are some inflationary pressures. And guess what? We're going to have to raise interest rates before 2023. I fully anticipate that they're going to do it. But right now, I do think that there's quite a bit of evidence still that this is going to be transitory.
Yeah, because Powell was quoted on regards to inflation, talking about how their target. We've talked about 2% inflation as a goal, but we haven't achieved it. He also reiterated the Fed wants to see inflation running moderately above 2% for some time, but he added, "I don't want to be too specific about what that means because I think it's hard to do that." So even at 2%, historically speaking, it's not a very big number, right?
No, no.
Okay.
In the U.S., though, the one thing that's different in the U.S., and that went under the radar during the pandemic, is that they reviewed their monetary framework, and they are now allowing what I would call catch up. Is that if you are in a situation where your inflation is running under target, then you're accumulating this underperformance. Let's just say, if you think of performance and reaching that 2% target, if you're accumulating this for a little while, then you'll be fine with overshooting for a little while. So I do think from that standpoint, there's credibility in the fact that we'll be fine with inflation running in that 2.4, 2.5, maybe up to 3 for some months, especially considering that framework. Now, what happens with the Bank of Canada, I'm not so sure, because we don't have the same framework. Mandate review is pending at the Bank of Canada, and so I just don't anticipate any changes, actually. So I'm not so sure what that means for the Bank of Canada, if the U.S. is willing to let inflation run a little bit.
On the way down with rates, I can't remember the timeline about how Canada responded to U.S. cuts or vice versa. But on the way back up, how will the bank how much will the Bank of Canada look at what the Federal Reserve's doing? Obviously, they did look at domestic monetary policy and what's going on here, but how much do they pay attention to the Federal Reserve and what they're doing as they come up with their own strategy?
Well, they have to, in the sense that it's, monetary policy is about anticipating the future. Because if you raise rates today, you're not going to have an impact until the next 6 months, maybe, and then 6 to 12 months, even, I would argue, right? So it's all about expectations about the future. And in that sense, given our linkages with the U.S. economy, for sure they're looking at what the central bank in the U.S. is thinking of doing, anticipating what the outlook is there for their monetary policy and so forth. But at the end of the day, they all have to bring it back to what is likely to happen with the domestic factors here. And that's inflation when it comes to the Bank of Canada. The U.S. also has a dual mandate with regards to employment and inflation. In our case, it's not. It's a single mandate around financial stability and inflation targeting around that 2%. And so it's all about anticipating future movements. And if they do think that the bank's going to sit on more inflation, well, they have to factor that in their analysis and what that means for us in terms of our own inflation target. And I do think this, you have to bring it back to what it means for us.
Yeah. Okay. That's a good point you made about it's really about how that decision today on the rate increase, how that impacts things 6 months from now. In the financial news, when you go to Bloomberg or CNBC, Fox Business, they're talking about that they raise rates today, how that impacted the market today. And that's really what it's not necessarily. They're not making decisions based on that. They're making decisions based on longer term outcomes. That's a good point.
And the beauty of it is that we have the markets to help us out figure what the future is going to look like. And right now the markets are telling us, wait a second, don't be so sure that rates are going to stay low forever, because they're pushing long-term rates higher. And that's what the markets are. That's the role of the markets, the financial markets, in terms of informing us about what is likely to happen in the future.
Okay. Quick question here from Phil, and thanks a lot for your questions today, Phil.
Yep.
How about negative interest rates? Wasn't the early stimulus put in to stop deflation?
Yeah. So negative interest rates would be a last resort policy if we were to have no control or no leverage on the economy at current levels. But before getting there, there's a ton of instruments in terms of what the central banks can do when it comes to monetary stimulus. What the Bank of Canada has done now has been to buy bonds and try to drive up the price of bonds, which lowers the yields. They've somewhat successfully done that, and they're going to withdraw it. So I do think that we're not close. We're not close to a situation as this. And negative rates, yes, they've been tried in Europe and so forth, but it raises a ton of issue. I mean, for financial institutions, it's not a pleasant scenario, frankly, because you have to deal with different accounting on your books. And so there are tons of issues with negative interest rates that we have to think about before getting there.
Great stuff. Hey, really appreciate the questions and some of the information today. JP, final thought for you, or final question for you. What can we expect to see out of the Canadian economy in 2021?
I do think that the current forecast of the Bank of Canada is a little bit low. Probably going to finish the year 2021 where we were at the end of 2019, which would mean, to me, which would be a positive scenario. Really, if we have the vaccine rollout successfully by September and we fully reopen the economy, we have, under some new rules for sure. But I do think that is going to allow us to bring, with the amount of stimulus, I don't think that's going to allow us to bring the economy back to what it was. And then, I do think that at some point in 2022, perhaps we're going to see rates go up. I think the bank will revise their stance on interest rates.
We've been talking today to Farm Credit Canada's chief economist, JP Gervais. I always enjoy these conversations. It is a lot of fun. JP, thanks a lot for joining us here today.
Thanks so much. It's always a pleasure.
Awesome stuff. Hey, I want to encourage everybody to go to Rural Radio 147 today on Sirius XM. Got a great farmer rapid fire today, talking to farmers from across the country, find out how they're making out, getting ready for spring. And of course, you can also download the podcast on iTunes. Thanks everybody for getting real and getting connected with RealAg Live, and we'll chat again tomorrow. Cheers, everybody.